Are you wondering what is going on with your portfolio if you own both stocks and bonds because you thought that when stocks go down, bonds would go up? That's what we're going to talk about in this video. Whether or not that really works, you'll be shocked with the information that I'm going to share with you. Hi, I'm Camille Gaines here, and on my website you can see here retirecertain.com. I write about investing. I've been investing for about 40 years, and boy have I learned a lot over the years. Not always the easy way. So in this video I want to share with you something that I discovered while I was putting together a program that I'm doing on investing, on how to retire when you want and have enough funds to support your desired lifestyle. So let me show you what I discovered, and I think you're just going to find this shocking. Let me get rid of this so I can show you. The way most investing is done is with just an asset allocation model. A lot of people still think that there's someone that should be picking stocks, that's really how to invest, or if you hire a financial advisor, they're going to pick stocks for you. But the way most investing is done now is based on an asset allocation model. And that asset allocation model just says you're going to put a certain percentage of your portfolio in stocks and a certain percentage of your portfolio in bonds. And you're going to do that because, like I was saying, when stocks go through those inevitable bear markets that they go through and they tank, basically, that bonds will go up. And that has happened a lot in the past few decades. But let's see if that's always happened and how often it hasn't happened. I think you're going to be really surprised. Back to the asset allocation model. This is how most investing is done. Even if someone picks individual stocks, they're also probably going to have bonds and or at least money market or something to offset some of the risk from stocks. So if someone had a portfolio of stocks and bonds, they might be picking individual stocks and or individual bonds, which is less common. It's harder to pick individual bonds than it is individual stocks. But overall, there's still often an adherence to that allocation of something like 60% stocks and 40% bonds. Please understand, I'm not recommending this. I don't make recommendations. I can tell you this is not how I invest. This is what I like to call FARO investing, and that's fixed asset allocation regardless of risk and opportunities. I invest based on risk and opportunities at different times because, well, there are various risks and opportunities based on what's happening in the economy and in the financial markets. But a lot of the people that watch my videos do have an asset allocation based portfolio. A lot of people that come to me and that I coaching clients have that fixed asset allocation model. A certain percent in stocks, a certain percent in bonds. Sometimes this is based on your age. It usually is, actually, and your risk tolerance. But what I really want to address here is this is done because, again, bonds are known to go up when stocks go down, and that's because investors want to flee to a safer asset, and this is typically with treasury bonds. And investors think treasury bonds will be safer than stocks, so I'm going to sell my stocks, go into treasury bonds, and that is the typical occurrence during a bear market. So let's take a look and see if stocks and bonds have really and truly moved opposite one another in various bear markets, because that's sort of the premise for holding stocks and bonds. So as it turns out, there have been about 6 years, or not about 6 years, there have been 6 years that stocks and bonds were both down. Now, as of this recording in 2022, it's looking like this might be another one of those years, because stocks and bonds have both been down, which has even led to this big sort of movement, or this big question: is the stock and bond asset allocation portfolio dead? And there are people that argue vehemently that it is, and people that argue vehemently that it isn't. But I like to look at facts and data, and that's how I make my investing decisions. Facts, data, not just assuming that what is commonly said is true, but let's see what's actually happened in the past, because what's so wonderful for us individual investors now is that we can do this. We have more information than we've ever had, and it used to be only the institutions could access this information. So if you had the 60-40 stock and bond portfolio, as I'm showing here, let's see if we had down years together. Sure enough, here they are. And this is provided by Financial Design Studio, this little chart. He did a really excellent article on the correlation between stocks and bonds. And you'll see that information here. So we see that in 1931, right here on the top, stocks were down about 43%, while bonds were down about 5%. In 1946, stocks were down a little over 8%. Bonds were down about, almost nothing. In 1969, stocks were down 8.5%, and bonds were down about 5%. In 1973, stocks were down almost 15%, and bonds were down a little over 1%. In 1977, stocks were down about 7%, and bonds were down almost 1%. And then we have in 2018, stocks were down almost 4.5% at 4.4, and bonds were down at 0.6%. So one thing I want to point out here is I mentioned bear markets. These aren't necessarily bear market years. Some of them might be, but these are years that both stocks and bonds have gone down, and there have been 6 such years. So what we want to look at next is a chart to show whether or not stocks and bonds have been negatively correlated. This is what shocked me, is that since 1891, and that's over here on the left of the chart, I'm kind of hanging out over here and blocking this, but this is 1891 right in here, and then 1901, and you can see 1911, etc. And going through 2020, early 2022, this was shocking to me. Stocks and bonds, well, let me show you. This is the zero line. The top of the chart is positive correlation, and the bottom of the chart is negative correlation. So what I mean by that, remember, sounds a little confusing, but that when assets are correlated, they are moving in the same direction. And when they're non-correlated, which is in investing lingo, it's called non-correlated, that means they're moving opposite one another. So what we're doing here is looking to see, do stocks and bonds really move opposite one another? And if so, how often has that happened? Because that is the whole thesis behind the asset allocation model that almost everyone is using now. For retirement funds, for investment funds, this is how people invest, whether individually or through a financial advisor. This is how millions, more than millions of people invest. So we can see most of the time there was a positive correlation between stocks and bonds. Oops, that blows this whole thesis that stocks and bonds are negatively correlated, the basis for asset allocation between stocks and bonds. Now you can see these are when stocks and bonds were negatively correlated. And what I really want to point out here also is we can see over here in this area, the negative correlation has been really nice. It's been very, very strong. And we can look though, and I always like to look at what's happening in the economy to kind of tell me how to invest. And we know interest rates were really, really high back here in around 1980, 1981, and we've been in a period, several decades, about 4 decades of declining interest rates. And we've also had really, really strong bear markets in the past couple of decades, and we've had a lot of Federal Reserve intervention. And hence we have this negative correlation. And when we look at, the other point I want to make around this is when we evaluate investment products or services or funds, normally the data that's provided to us by the company sponsoring that information is for the past 10 years, maybe the past 20 years, depending really on how it looks, right? Because everything's presented in the best light. And so if we look at the past 20 years of data, well, yeah, there's been a really, really great negative correlation between stocks and bonds. Who wouldn't conclude if they only looked right here, look from 2001 through early 2022, you'd go, oh yeah, great. Stocks and bonds have negative correlation. It's just kind of a given. Like everybody just holds that to be a truth. And that's why I love looking at the data, because we can find things that allow us to go, well, wait a minute. Is my money safe making this assumption? It doesn't feel safe to me. In fact, as it turns out, 71% of the time, stocks and bonds were positively correlated since 1891. And that's research compiled by AQR Capital Management here. You can see their name at the bottom, who did an excellent study on this. So, oops, this is big. This is big. Stocks and bonds have been positively correlated more often than they've been negatively correlated, significantly more often since 1891. Now, I used to sort of think, nah, that was so long ago. Things have changed. I don't think things are going to be the same. I just don't think that way anymore, because it's simply not true. When we look at really, really long-term cycles and we look to the works of really excellent investors and the research they provide, such as Ray Dalio, we can see that we do need to consider these long-term trends in making our decisions about how we invest our money. So that's what I really wanted to show you in this video. Now, I mentioned that I'm putting together this information for a course, and let me show you where you can learn when I provide the course. I'm still working on it. It was going to take a week, and I've been working on it about 6 weeks now, because I just keep finding more information like this that I want to share. And I actually go into when stocks and bonds are negatively correlated and when they're positively correlated and what influences that. Because the older we get, the more important it is to keep our money safe. But it's also really important at all times, because losses are important. They can cause huge setback from which one can never recover. So take a look, retirecertain.com, LMK for let me know, and you can sign up to get notification when I actually launch this course. It won't be long. Thanks for watching, and remember, above all, retire certain.